Hi everyone, and welcome to the Advanced Markets Concept Corner. I'm Carly Brooks. I'm here today to share with you a unique and flexible way for married couples to own life insurance using what we call a survivor standby trust. This technique allows for a client to have full control over their policy today while managing estate tax exposure in the future. Let's walk through how it works. There are many reasons irrevocable trusts are used in estate planning. First and foremost, once cash or assets are transferred to the trust, those assets and any appreciation are removed from the client's estate for estate tax purposes. The irrevocable trust structure also allows for the client to control when and how distributions are made, and depending on the trust terms, may enable the trust to grow for multiple generations. Irrevocable trusts also provide increased creditor protection from third parties, spendthrift beneficiaries, ex-spouses, and more. And when assets in an irrevocable trust are leveraged with life insurance, the death benefit can provide estate and income tax-free death benefit that can help increase the total amount to heirs and provide a meaningful legacy. But the downside to irrevocable trust planning is that once the asset is transferred to the trust, the client gives up control over those assets, making this type of planning very inflexible for changing personal circumstances and/or tax law changes. For married couples who want greater control or who may be below the high current lifetime estate tax exemptions, the Survivor Standby Trust can be a great alternative ownership structure. The Survivor Standby Trust concept utilizes a credit shelter trust that's going to be created under the client's revocable trust. As a refresher, a credit shelter trust is funded with the first spouse to die's remaining lifetime exemption. The beneficiaries of this trust can be the surviving spouse, descendants, and even charity. When the surviving spouse dies, the entire trust value is excluded or sheltered from that spouse's estate. Let's walk through how the credit shelter trust is used to provide an alternative ownership structure. The first step is that the spouse with the shortest life expectancy is going to purchase a second to die life insurance policy that he or she will own personally. The spouse will name the credit shelter trust created under his or her revocable trust as the contingent owner and beneficiary of the policy. In this sense, the credit shelter trust stands by as the owner and beneficiary. Because the spouse owns the policy personally today, he or she will pay the life insurance premiums from personal funds, which means that no gifts have to be made. Additionally, because the policy is personally owned, the owner spouse retains the right to potential policy cash value and has the ability to change the beneficiary at any time if needs change for any reason. During the owner spouse's life, the policy can be transferred at any time to accomplish additional planning objectives or to account for an out-of-order death. For example, if the younger or healthier spouse dies first. Upon the death of the older spouse, who in this case we assume is the first to die, because the credit shelter trust was named as the contingent owner, policy ownership is transferred automatically to the credit shelter trust at its fair market value. The fair market value is included in the older spouse's estate, but is likely going to be a much lower value than the death benefit. Now that the policy is owned in the trust, this is beneficial for a few reasons. First, depending on the policy's design and the trust terms, the trustee may access potential policy cash value and make distributions to the trust beneficiaries, which typically includes the surviving spouse. And secondly, at the surviving spouse's death, the policy death benefit will be paid to the credit shelter trust free of estate and income taxes. This strategy helps provide flexibility and control for a few reasons. First, the owner spouse has unencumbered access to potential policy cash value. This is really attractive because the policy or plan can now be adjusted to meet changing planning goals during the client's life. We're not asking the client to give up control today. The plan also requires no gifting today, but it helps to limit estate tax exposure in the future because if the owner spouse dies first, only the fair market value, as opposed to the full death benefit, will be included in the estate. The death benefit, which is now inside of the trust, can be used to meet a variety of estate planning goals and can help enhance the total legacy left to loved ones. If you think this strategy could work for your clients, reach out to John Hancock Advanced Markets for guidance and to learn more. Thanks so much for listening and have a great day.